Did you know that there's a good and bad time to buy covered call ETFs? Yeah, so that's what we're going to talk about today. This is actually quite exciting because this is something that I've been looking at for a long time. I've been thinking of making a video on it, and I thought, hey, why not help you make more money? So that's what we're going to do today. So first off, what is a covered call ETF? Basically, it's when you hold stocks. For example, the ETF holds stocks, and you are selling the option to buy that stock at a future date, at a future price strike date, and of course at today's price. So for example, if let's say TD stock is currently worth 60 bucks and you say in 6 months it's going to be worth $75. However, I'm going to give you the option to buy it at today's price in 6 months if it hits $75. If you give me today, let's say $250. And that would be for 100 shares of TD. So you can buy 100 shares at $60 6 months from now when it's worth $75 if you give me $250 today. However, if it does not hit $75, then you do not get the shares. I keep my shares and I keep your $250. Basically, long story short, this is how a covered call strategy works. And you're probably wondering, well, that seems risky, and of course it is slightly more risky, but at the same time, you are the one playing casino. They're the ones who are gambling, even though you're still slightly gambling anyways. So why is there a strategy on being able to buy these these covered call ETFs based on that strategy? Well, let's get down to it. Let's look at ZWB, which is the BMO Covered Call Canadian Banks ETF, just as an example. We're currently looking at, for example, just for the sake of arguments, we're looking at TD Bank. Currently, the call option is for July 16th of this month, of this year, I should say. And of course, the strike price would be for $90. That means that by July 16th, if the stock hits $90 per share, we lose 14,000 shares at whatever the price was when they made that call option, which is a substantial part of course, our number of shares. However, the question is, will TD hit $90 per share by July 16th? Currently, as of July 11th, which is a Sunday, so of course this Monday would be July 12th, this is obviously being posted in the future. Currently, TD stock is being valued at $84.70 per share. Currently, TD just had a double moving average crossover, which means that there's some downwards pressure potentially coming to TD. And of course, CIBC also has downwards pressure from a week ago that will be downwards pressure for over the next 21 days minus 7 days because it happened a week ago. So both of these covered calls have downwards pressure on the stock anyways. So what we can then look at is the fact that TD is about $6 roughly away. It's about $5.30 away from its call strike price, which is $90. So why is this substantial information when it comes to call option or covered call ETFs? Well, let's really look at it. Well, when we have a call option out, we could be losing up to 14,000 shares. In this case, 14,000 shares. And that is substantial risk, but at the same time, we made substantial premiums off of that risk. From there, however, we can now see that there is a very low risk of the actual ETF losing those shares. Now, we can go in, whether it be today or even Monday of the week after, so Monday coming next week, not this week, and we can then look at it and say, well, you know what? It's not going to hit that strike price. We can now look at the ETF and say, well, now that ETF looks pretty promising. It's not going to be losing many shares. So by looking at the call options they currently have out on the shares that these ETFs have, we can then look and forecast as to where this ETF is going. Now, for example, if they had that $90 covered call out, and let's say the price of TD currently was $105, we would then look at that and say, wow, there's going to be some downwards pressure on this ETF. We should probably not buy it yet. If there's a lot of covered calls out, and we see that a lot of those stocks are well above the strike price, wait until after those covered calls are finished. So for example, if those banks were above that strike price, I would personally hold off until the week after, the Monday after, because then you will see that stock price of the ETF potentially come lower, and then we can get a deal while it's lower instead of buying when it's a bit higher and waiting for it to recover back. So I hope that this kind of strategy helps you, and if it does, hit that like button and subscribe. It's really helped me in the past, so I'll see you guys again in my next video. Of course, hit that like button and subscribe.